The next speaker is Kevin O'Rourke from Trinity in Ireland.
Yeah. Okay, thank you very much indeed to the organisers for putting on such a fabulous event. So this is a paper about the political economy of EMU and the EU in general. But at the end of these remarks, I do want to say something about Ireland, because Ireland is a wonderful illustration of some of the themes that have been coming up again and again during this conference. So this is a tale of two trilemmas and how they relate to European monetary union. The first trilemma is one that we're all familiar with from teaching international macro to undergraduates. It's the Mundell-Fleming monetary policy trilemma. And European monetary union can be seen as a response, a particularly radical response to this particular trilemma. And in a way, it's a logical response given the prior decision of the Europeans to liberalize capital markets as part of the single market program. But as Andre said in his introductory remarks, this monetary union is a very odd beast indeed. It's a monetary union without a fiscal union, and it's a monetary union without a common framework for regulating banks and for dealing with the causes of their failure. And the question is, are we stuck with this? How did we get here in the first place? And where do we go from here? Now, these are inherently political questions, and although I'm not a political scientist, I thought that I'd at least try to say something about them. And one framework that's useful in helping organize our thinking about these issues is the political trilemma that Danny Roderick has been selling in recent articles in a book that has just come out. And the way to introduce this political trilemma to people who might not be familiar with it is just to take you back to Gordon Brown's speech yesterday at lunchtime, because that's really what Gordon Brown was talking about. If we know anything about our citizens, we know that the one thing that they are desperately crying out for is firm measures to rein in this out-of-control financial sector so that it never ever does to us again what it has just done. The problem is that if financial policies are organised at the national level, it can be very difficult for a national government to meet these political demands unilaterally because the financial sector may simply decamp to more favourable regulatory climes. So what do? The solution that Gordon Brown was proposing is that we bump up these regulatory functions to a supranational level. In other words, you move towards global governance in this particular area. And if you look at the way that the European Economic Community developed in the 1950s, that's precisely the way that they went. They chose to go towards regional governance because they wanted deep economic integration, but they also wanted this international market to be firmly embedded within politics and the constraints that the post-war environment imposed upon governments. An alternative solution, of course, would be to say, I don't like that multilateral business, but I am a convinced Democrat, so I'm going to provide these regulations at the national level. In that case, you may find yourself having to back off a little bit from deep economic integration, throw some sand into the wheels of international finance. And Danny's characterization of the international political economy of the 50s and 60s is that is precisely the way that they went at that stage. Now, the funny institutional structure of EMU can be quite nicely slotted into this general picture. EMU itself is, of course, the deepest of all possible deep integrations, but then if you look at these complementary institutions that we'd like to have, some sort of fiscal union, some sort of a common framework for dealing with banks, you can see that we're stuck. When it comes to fiscal policy, it's the nation state and democracy that dominates. The Germans do not want a transfer union. The Irish do not want common tax policies. The Lisbon Treaty enshrines fiscal policies as being an exclusively national competence. So that's where we are with that. And then when it comes to banking regulation, you can see that we're in this awkward position where we have the deep integration that makes unilateral regulation difficult, and we're still facing, I think somebody said today, a bit of a regulatory race to the bottom, or at least the risk of that. Although maybe the British people who are in this room from the Bank of England will prove us wrong, and that would be just terrific if they did. The question then is, where do we go from here? Can we move on? And here you have to take into account the basic politics of the European Union more generally. And there are certain long-run factors that you have to take into account, and then there are short-run factors having to do with this crisis. So let me take the long-run factors. First of all, So first of all, the old permissive consensus that had characterized European attitudes towards European Union, European community back in the sort of 60s and 70s has vanished. And it vanished in the early 90s when people started to realize that Europe was intervening more in issues that affected them. And one of the big complaints that you hear from Europeans all the time is that there is a democratic deficit. I think, again, you can make sense of that in the context of a suitably recast trilemma. When citizens means democracy, they mean a directly elected parliament that just decides stuff, you know, and of course you could have that at the European level. Well, we have a European Parliament, but it's not where the real locus of power is. You could have direct democracy at the national level, and you could still have intergovernmental cooperation, but that would involve national vetoes and this sort of thing. And it would be hard to see the European Union really driving agendas at the global or the European level if that were the way that things were run. So what we have is this awkward halfway house where we do have deep political integration, but we have it largely run by nation states, and that's where you get the meetings in Brussels and people coming home and presenting their parliaments with fait accompli. And that's where the basic issue about the democratic deficit comes from. Now, it's important to stress that the Lisbon Treaty addressed a lot of these issues head on, but it's still a work in progress, and that basic hostility is still there. It's a political factor that you have to deal with. And by the way, I think that there are cautionary lessons here for more global aspirations towards multilateralism, because you do have to figure out how you make these global decisions. A second basic fact about European politics is that there are cleavages between countries. In particular, when you talk about European monetary union, there's the basic fact that we all know, which is that the Germans didn't like it. And this does impose various constraints, I think, on what is politically feasible going forward. And then there are cleavages not just between countries, but within countries. And in particular, the unskilled and the poor are systematically more hostile towards the European Union and EMU than the skilled and the rich. Now, I tend to interpret, because of previous work that I've done, I tend to interpret these correlations within a sort of basically Hexarolan framework. I think these attitudes are very strongly correlated. In fact, they are. I show it in my paper, with attitudes towards globalization in general. This makes sense because European integration is a regional manifestation of a broader phenomenon. Those class cleavages emerged very sharply in 2005 when the French rejected the so-called constitutional treaty. They emerged very sharply in 2008 when the Irish rejected its successor. Another interesting correlation that you find looking at attitudes towards EMU specifically is that whereas the unemployed tend not to like it, pensioners are really rather keen on EMU, except for in Germany. And if you think about it, that makes sense. If you think about the interests of pensioners who want a nice hard currency pension in their old age, I think this does make sense. And you can see those generational cleavages coming to the fore very much in Ireland, and I imagine other peripheral countries as well, as we speak. Now, on top of all of these long-run cleavages, intranational, international, there's then the crises, the strains imposed upon the system by the economic crisis of 2008-9, and then the banking crisis, which came along 2 years later, as was the case during the Great Depression. Now, in a time of crisis, you might well end up looking at the European Union as a shelter in the storm. I think Harold mentioned Carr's view in his talk in the opening session. Carr's view that when times are tough, you want to be part of a big unit. And you can see an element of that actually in the Irish decision to accept the Lisbon Treaty in 2009. Very clearly it was felt that it was actually in our interests to be part of a big, powerful unit. But as you can see from these graphs, by and large, that's not the view that has prevailed. By and large, attitudes towards the European Union are becoming more skeptical, and most particularly trust in the institutions of the Union, which is a different thing than your attitude towards the Union in general. Trust in the institutions of the Union is taking a bit of a nosedive. That's true for the institutions of the Union in general. It's true for the European Central Bank in particular, and I can certainly tell you that trust in the ECB has taken a bit of a nosedive in Ireland recently, and these data bear that out. So that does seem to be a good moment to segue to some of the more recent things that we've been experiencing around the periphery, in particular this banking crisis, as we like to characterize it in Ireland. So there was a conference called last autumn between a senior Commission official, who shall remain nameless, and a bunch of investors. And the Commission official went out of his way to reassure the investors that in the event that there would be a general election in Ireland, and in the event that this election would lead to the election of a new government with a clear mandate to do some burden sharing with senior bondholders, in such a hypothetical event, such a new Irish government would be prohibited, his word, prohibited, from imposing such burden sharing on bondholders. Now, Ireland's a small country. We all found out about this almost immediately. And guess what? This is exactly what happened. That's exactly what's happened over the last 2 or 3 weeks. We've had an election. We kicked the bums out. Fine Gael and Labour both said, we want to impose burden sharing. They went to their first meetings and they came back with their tails between their legs because this had been vetoed by Frankfurt. Now, I think in general, the notion that a central bank would intervene in the most political of all political decisions, which is how to allocate the losses consequent on a banking collapse, is rather extraordinary. More to the point, more positively, less normatively, I don't think this is going to do anything to improve the image of the Union in my country. And of course, the real disaster here is that the image of the Union isn't being improved in the core either, because by insisting that it's only taxpayers that bear the burden of dealing with the consequences of this banking collapse, you're setting up a collision between core taxpayers and periphery taxpayers. Because if they're the only one that's going to pay, then that's the only interesting question: whose taxpayers pay? And this is not really, I think, where we want to be. Let me say a little bit more about Ireland and get back to these generational cleavages. So people of a certain age tend to think that this is a crisis just like the 1980s, and that we grew our way out of the crisis in the 1980s, and that therefore we can grow our way out of this crisis, and that we never defaulted on anything in the 1980s and we won't have to default on anything today. Now, there are lots of obvious differences between now and then. We're in a monetary union, so we can't devalue, which we did then on 2 occasions. And there's austerity being pursued elsewhere, which was not the case in the 1980s. But most fundamentally, it's a different sort of recession. The 1980s recession was a bog standard squeeze inflation out of the system recession. This is a massive balance sheet recession of the sort that Richard Koo talked about yesterday, and it's been driven by the most extravagant asset bubble in history, or at least one of them, and the Irish asset bubble was really extraordinary. And so we have now all of these feedback loops, these deeply vicious negative feedback loops between income flows and household balance sheets and corporate balance sheets and bank balance sheets and lending decisions and investment decisions, and we're locked into a deeply negative spiral. And what we need now is a shock to the system that will jolt us out of that spiral and shift us from an equilibrium trajectory that is catastrophic to one that is merely disastrous. But it isn't clear that we're going to get such a shock anytime soon. I think the macroeconomic data that I've shown this slide speak for themselves. But what I really want to emphasize, given the theme of this conference, is that if our authorities have been permanently behind the curve when it came to estimating just how bad this crisis was going to be, if they're permanently over-optimistic in their forecasts about economic growth, if they're permanently over-optimistic, therefore, about the ability of the Irish state to pay for these failed banks, it's partly because they've got the wrong model in their head. They really do think it's just G going down, and then there's a multiplier. When they don't think it's negative, they're not that crazy. There are people in Frankfurt maybe who believe in expansionary fiscal contraction. Most Irish people don't, but they think it's a small multiplier because we're a small open economy. And then you're going to get a big increase in X, and that's going to be enhanced by internal devaluation strategies, and the one will balance out the other, and we'll be able to grow our way out of this. And that's obviously not what's happening, because it is a balance sheet recession, and that changes everything. Let me also point out that this time last year, we were the poster boys for austerity. In that spring of 2010, when Europe as a whole shifted from a focus on deep recessionary problems that we were facing to a focus on debt, when the Greek crisis changed everything, we were the people that you had to follow. We were being brilliant at imposing austerity on our people, and our people weren't rioting, and they still haven't rioted. They have kicked the bums out, but it's been through the ballot box, and that's something that I think is, I won't say it's remarkable, but it's something that we can feel okay about as a people. But then you look at whether this austerity has succeeded on its own terms. To date, cumulative austerity measures have amounted to 13% of GDP, and yet we're still stuck with a deficit of 12% of GDP, which is exactly where we started. That may not come as a big surprise to you. I imagine it's doing their heads in Frankfurt, and I also imagine that they'll do the old thing of basically assuming that we mustn't have been doing austerity at all, that obviously we cooked the numbers or something. I mean, there must be some cognitive dissonance going on there somewhere, I feel. So this time is different. in Ireland. The left-hand bars are where the debt to GDP and debt to GNP ratios peaked last time around. The right-hand bars are where the IMF are saying they'll peak this time around. The ones to the extreme right are if we draw down the entire 85 billion out of our package. And the ones just to the left of that are assuming that the 24 billion recapitalization program that was announced the other week is sufficient. I did put in 2007 there, just so that you all see that this time it really is different. This is not a debt crisis caused by accumulation of fiscal deficits over time. This is a debt crisis caused by plonking the bank's balance sheets on top of the sovereign, right? And there are two major uncertainties that could make these numbers look worse. The first is continuing uncertainty about growth rates, because these projections, make assumptions about nominal growth that you might think are out of line. And secondly, how much of these contingent bank liabilities are going to end up on the shoulders of the sovereign. It might not be enough at this stage. The people who've been right so far about the cost of the banking crisis are saying that the eventual cost won't be 70 billion, but 90 or 100 billion. Well, at that stage, we have debt to GDP ratios, debt to GNP ratios well in excess of 150%. So, in conclusion, I'm a convinced Europhile, actually, and this crisis has been a sore disappointment to me. I really felt in 2008 that this was a moment where the European Union could make itself work for ordinary citizens, where it could pursue some sort of a new growth strategy based on investment in the stuff we're going to need anyway, the energy and the transportation infrastructures that clearly we need and that clearly should be provided at a European level. Instead, the European institutions have become the greatest cheerleaders of pro-cyclical austerity on the planet, nor have we made much progress towards common banking regulations. So, in conclusion, will EMU remain stuck between these two monetary and political trilemmas? Can it survive if it does? And what does all this imply for the broader European project? The truth is, I don't have a clue. It all depends on political leadership, which has been in very scarce supply to date.
Thanks, Kevin.